I'd love to catch up with you when you...
We're on mic. You're very kind. Thank you.
Guns, that's for you.
Morning, ladies and gentlemen. My name is PR Ganapathy. I'm your moderator for this panel today. Thank you for joining us. Those of you at the back, if you want to come a little further forward, then we'll make this a closer and intimate session. We have a great panel today, lots of global investors who've been investing in India for many years, people who've lived in India, people who live overseas but invest in India, to offer you really perspective on impact investing in India. As most of you know, India is a country that both has large numbers of social problems, but at the same time a very rich and vibrant entrepreneurial ecosystem and enabling environment that creates a lot of innovation in social impact entrepreneurship. So we're going to learn from this panel of experts some of the lessons that they have learned and some of the pitfalls, some of their mistakes, and what should you keep your eyes out for when you look at investing in India. So what we're going to do is maybe just go around first and get to know the panel a little better and their experience in India and some of their big lessons, mistakes, as well as successes. So we'll start with you, Sandhya, from Khosla.
Sure. I help run Khosla Impact Fund, which is an early-stage technology venture fund for high-impact startups. We invest across India and Africa. And we mostly focus on companies that are building technology or innovating on product to be able to reach the bottom half of the economic pyramid. We invest across multiple sectors, so we're sector agnostic, but focus a lot on what is the technology that the company can build to solve a problem or try a new approach to existing problems, since we are dealing with issues that are decades old.
And how long have you been in India, and what sorts of...
Our fund is a fairly new one, so we've only been active for about 3.5 years. Okay. I myself am from India. I have been investing in India since 2009, but Khosla Impact is relatively new.
Okay, and big lessons learned, mistakes?
There are, a very long and interesting list, and I'm sure we will have an opportunity to go through it as we go over this panel and the great set of questions and topics that you have put together. If I had to pick kind of one big lesson that I have learned personally, it would be, for India, it would be that we need more focus on product market fit. I find that a lot of startups in India today are both in the impact and kind of the general space get carried away with the trends that are that they can see in the global startup ecosystem and are often trying business models for no other reason than that it has worked somewhere else, as opposed to doing real bottom-up customer research and gathering customer insight on what it is that will give them product market fit for the Indian ecosystem. Okay,
great, wonderful. So Maya, you founded Elevar many years ago. You have many years of experience. So tell us a little bit about your experience working in India.
Good morning, everyone, and thank you, Guns. I'm Maya Korangal. I'm one of the founders of Elevar Equity. We are a venture capital investor managing about $170 million, investing out of our third fund. We do invest in India and in Latin America. We have teams based in Bogota, Colombia, and in Bangalore, India. We have about 12 folks in Bangalore who are focused both globally and on the Indian market. We are generally very early stage investors, so we have gone in at the seed stage, at the Series A, in a few occasions at the Series B stage of companies. We're focused primarily on financial services, but look across verticals in addition to financial services like education, healthcare, housing, agriculture. And over the course of our investing experience, we were early in the days of microfinance, starting investing about 12 years ago now in the microfinance space. Our first fund was the first truly commercially oriented investor in microfinance, where we believe that you could have great impact in terms of financial inclusion, but achieve market rate returns. And over successive funds, we have branched out beyond microfinance to look at other core services that are needed by low-income customers who are largely underserved by formal markets. And the themes of financial services, education, housing, healthcare, communications technology are really driven by where the biggest pain points and the biggest spend and the biggest requirements are from base of the pyramid communities. So to preempt the question on lessons learned, I think just to add a little bit to what Sandhya was saying in terms of having at the core of our investing thesis, everything driven bottoms up. So we spend a lot of time in the field. We like to say that at Elevar you can get fired for two things. You can get fired for lack of integrity, and you can get fired for not spending time in the field. And so all of our investment hypotheses and the way that we look for entrepreneurs is driven by insights on the ground in terms of what the customers want themselves. And then the second big learning is execution, 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 execution. Our biggest failures have been behind entrepreneurs who have tremendous vision but don't know how to execute on the ground. And our greatest successes have been about backing great entrepreneurs who have proven execution experience, who have deep knowledge of the market, who have a deep love for the customer. And our biggest sort of test in the due diligence process when we're looking at entrepreneurs and markets is walking the streets with the management team, with the founding team, and seeing how they relate to the customer and understanding whether it's authentic and deep. So I would say those are our biggest learning. We've had lots of failures, but we'll talk about that later.
Okay, great, thank you. So Mark, you probably know India better than I do, I'm embarrassed to admit. You've been there many years. Tell us a little bit about Omnivore and your experience there.
Thanks, Guns. My name is Mark Kahn. I'm the co-founder of Omnivore Partners. We are an impact fund focused on agriculture, food, and the rural economy. We are very much a technology investor in the sense that we focus on Indian startups developing breakthrough technologies for food and agriculture. And for rural application. We've been around since 2011. I guess similar to others on this stage, we focus on fairly early stage investments. We tend to write seed and Series A checks, or as we like to put it, since all of those definitions mean nothing anymore, thanks to the Valley, that we are the first institutional money that comes in after the angels. I think if you look, we've done 12 investments to date. We have a very national footprint. We have investments in far eastern India in places like Guwahati, in far western India in places like Rajkot. I think we did the first venture deal ever in Vijayawada. So it's a very large national footprint. And I think in terms of preempting the question on lessons learned, I would say kind of two big ones. One is beware technical founders that can't sell. So one thing that I think we've seen over the years, and some of these are deals we did, and some of these are deals that we almost did. There are many, many brilliant engineers in India. It's one of the great advantages of the country. A smaller proportion of those can actually execute on selling product. And so we've learned over the years to be very wary where there's not a full complement of talent in the team to really drive sales execution. And I think the second lesson learned has been on working capital cycles. India is brutal with respect to working capital, especially for early stage companies that don't have a lot of leverage when compared with the channel. And so we've seen this across agri-input sectors. We've seen this in food, in branded food companies. The channel will suck up as much of your capital as it thinks it can get away with. And it's just something to take in mind as you plan execution in India.
Wonderful, that's great. Welcome, Roopa. Omidyar has been an impact investor as well as given grants in India for many years, for many causes, and you've had deep experience of looking at companies, commercial companies at CRISIL, and then after that now at Omidyar. Tell us a little bit about what Omidyar is seeing in terms of your experience.
So I am responsible for Omidyar Network's investments and strategy in India. Omidyar Network is an investment firm backed by the philanthropic capital of Pierre Omidyar, the founder of eBay, and his wife Pam. We invest in early stage entrepreneurs who have innovative ideas and use technology to achieve impact at scale. We've been in India since 2010, and by the end of this year, we would have committed nearly $200 million to India across over 60 organizations. organizations. We work in 5 sectors: consumer internet and mobile, which we now call emerging technologies, financial services, education, governance and citizen engagement, and property rights. And in each of these sectors, we deploy a unique model of 2 checkbooks that Guns referred to. So if you're a non-profit, we will give you a grant. And if you're a for-profit, we are typically a Series A investor. We do invest in subsequent rounds, and our largest exposures to a single organization can reach about $10 million. In the 5 years of working in India, there have been many, many lessons, and some of my co-panelists have alluded to several of them. I'd like to point out 4 key lessons that we've learned in India. Lesson 1, we believe that there is a huge opportunity for companies to provide goods and services to the category of population that earns between $2 and $8 a day in India. And this is the population which is not quite at the bottom of the pyramid, but does not fall into the category of the traditional middle class either. So it's somewhere in between, and there is a huge opportunity. We've seen entrepreneurs using different types of models to serve this market, but the most popular model is a model which is a mixed income model, which means catering to customers who are not just within this category, but also in income segments that are slightly above, which helps them reach scale and unit economics. We've also seen the second element of this model is to keep the model asset light. There are other types of models also to serve this segment, which I'm happy to talk about subsequently. Lesson number 2, in India, it's important to have patient capital because it takes longer than you would ever expect, both to reach scale and to exit. Lesson number 3 is that our model of 2 checkbooks, which is the grant checkbook and the for-profit commercial investment checkbook, is very useful when you're trying to change sectors. So where do we use grants? We will use grants in, for example, at the very base of the pyramids where markets don't function, or where you need to support policy changes, or where you might need to build out sector-level infrastructure. And in all other cases where the company is providing a value which is scalable, sustainable, we will use our for-profit equity checkbook. And lesson number 4, I really believe that India's time for impact investing is now. On the one hand, you have the general ecosystem for entrepreneurship, which has never been as good as it is today, whether it be in terms of its ability to attract funding, to attract some of the best talent. 10% of the graduating class of the IITs, for example, today goes into startups, which is quite unprecedented, or government policies in a whole variety of ways which are trying to be supportive. And on the other hand, you have the drivers of social impact, which are gathering momentum, be it increasing penetration of mobile phones, be it a rapid increase in the number of bank accounts, new skills policies, new ways of government experimenting with land acquisition, etc. So the combination of the two makes India a great market for impact investing, and indeed it is one of the leading hubs in the world today for social innovation and impact investing. We have the India Impact Investors Council in India, which is a forum of all the impact investors. Given the momentum that we are seeing, the Impact Investors Council is organizing its first conclave later this year in November, middle November, 15th to 17th November. And if we welcome all of you to come and attend that, because I think it's a reflection also of not just the interest in India, but what has been achieved so far, and also I think it offers an opportunity to share learnings across the world.
Wonderful, thank you very much. So Raymond, you've been an old friend of India. You've lived there for many years. I think a significant portion of your current portfolio is there. Tell us a little bit about the Global Innovation Fund and your experience there.
Thanks. Hi, everyone. So I'm Raymond Guthrie. I'm a senior partner at the Global Innovation Fund. The Global Innovation Fund is an investment vehicle seeded with funding from the United States government, the UK government, the Swedish government, and the Australian government. Unlike my colleagues, we're an open-ended fund, and we also do utilize both grants and like for-profit investment type vehicles. We're about $200 million right now and growing. We can invest as small as down to $50,000 all the way up to about $15 million in any given company. It's all dependent upon the level of impact and level of evidence that they have. India makes this year will probably be about 20 to 30% of our investments, but we're country and sector agnostic, so we invest all over the world. But our main goal is to invest in products, companies, and business models that help target and benefit people that live off of $5 a day or less. But our main guiding star is that we're only going to invest in things that can demonstrate a measurable amount of impact and an ability to actually show whether or not the investment is creating impact for those people. So lessons learned, I think my distinguished panelists made a lot of really good points. I think what we see in India that's different than most is that a lot of money is going into a lot of things that aren't creating impact. And so what we're doing is taking a step back and looking at what sectors, what areas actually are capable of creating measurable impact and putting the right type of capital to support them. So not taking an entrepreneur's company for $50,000, but giving them the working capital loan that they need, or giving them grants alongside a working capital loan to build out the company. So what we're seeing is that, like I said, a lot of money is going into places that aren't necessarily creating an impact, and we're trying to help push money towards and demonstrate what types of companies are creating impact.
Great, wonderful. So let's peel the layer of the onion and maybe get beyond the first level of stories and lessons, and speak about just the pipeline of entrepreneurship. As you all know, entrepreneurship has increasingly become the craze in India. Everybody wants to be an entrepreneur or join a startup. And so we're seeing increasingly a flow of talent, but is that translating in the sorts of companies that you look at? And I'll ask Mark and Sandhya to weigh in on this one. Are you seeing this as better pipeline, more pipeline? What trends are you seeing there?
So I'll put it to you this way. When we started this whole journey, when Janesh, my co-founder, is sitting there in the audience, and I launched in 2011, if you had asked me what my greatest fear was, it was a lack of pipeline, right? Whenever you start a fund, right, it's to an extent, especially if it's an early stage one, it's a little bit like starting a startup. Not everything's not there yet, right? And you have a theory, and you want to see if you can execute. And our theory was that essentially there was a capital hole for startups that were dealing with food, agriculture, and the rural economy in India, and that traditional VCs wouldn't touch them, and that the impact funds were all too small, and that no one had enough capital to really scale up and focus on that space. And I had a handful of companies that I thought we could do, but I knew that with this fund we'd have to get to 12 or 14. And that first couple of months, we had to hunt for everything we were doing. And if you really look at the first year or two of Omnivore, it was scouting, right? If the Indian Railways gave a platinum status, we would have had it. We spent time in the most, tons of smaller towns and cities as we looked for our first agricultural mechanization deal. We had teams of interns from the IIM scouting deals in the Northeast. It was heavy, heavy field deployment. And that worked, right? That brought us deal flow. I think now, 5 or 6 years later, I can say sort of, quantitatively, we used to get maybe one deal a week through the door that we didn't hunt, and now we probably get 5 deals a week. And a lot of that is just that we built a brand as sort of the go-to early stage investor for ag tech, food tech, and rural. And so we just see a lot more. But I also think it has to do with the fact that, you know, as was said by my colleague over here, the overall environment for startup investing in India is hugely developed over the course of the last 5 years. I wish I could say it was us, but it's not, right? It's just that 5 years ago, when we started, entrepreneurship was still something done by a select few brave souls. And I think really what we've seen happen over the last few years is a global trend where entrepreneurship is respected, if not worshipped, right? I think the second thing is the alternatives have become worse. Once upon a time, people, young engineers in India, dreamed of a lifetime at Infosys, your old employer.
Yeah.
That is no longer the case, right? The best and the brightest in the country are really looking at startups as the way to create wealth for themselves and for their families. And so the nice thing about being Omnivore is we sit right alongside 2 trends. One is the largest smallholder agriculture system in the world, and the second is one of the largest startup ecosystems in the world. So I don't need every young person to launch a team over here, but as this grows, as the startup ecosystem grows, maybe 10 or 20%, right, of startups are looking at this market that represents 50% of the population and 20% of the economy and saying, you know something, I don't want to do another food delivery app. Let's go build something for this. And those numbers have skyrocketed.
Excellent. And Sandhya, what trends have you been seeing in the field that you're focused on?
Slightly different from Mark, actually. I mean, when I started working in VC in late 2008, at that time we were already bringing in 10 new deals a week. I have never had a quantity problem with startup pipeline in India. You know, NASSCOM says, well, there are like some 5,000 startups, right? There is no quantity problem. And probably since Mark was focused on a niche sector.
You were at Sequoia.
Yeah, and the difference was also the amount of incoming has definitely changed because the awareness of venture capital as a category of, you know, the whole ecosystem of equity financing, the amount of awareness there is around the idea of equity as an asset class has increased a lot, thanks, you know, probably in main thanks due to like Flipkart and the few success stories that we have out there. There's also a huge change happening in the angel and seed stage ecosystem, right? Now we have probably about, you know, anywhere between 200, 300 active angel investors, which was not true 5 years ago. We probably have 50 new seed funds that got launched just in the last about 6 to 8 months. So there's something new happening here, which I think will have an enormous impact on the impact investing ecosystem, because now that you have so many new funds coming in, which need to be differentiated from the, you know, top kind of general funds, there'll be a lot more sector specialization. I already see funds that are saying, no, we only focus on healthcare, we only focus on this particular space. And though they don't think themselves of impact investors, because they are focused on a particular sector, they are very open to investing in companies that traditionally only had access to impact dollars. So there is definitely a maturity in terms of the amount of infrastructure and people that are looking at the space. In particular, to answer your question about kind of, you know, what pipeline we are interested in, I would say there are kind of 3 sectors that we are focused on in India right now. One is, of course, fintech, given the active engagement the Indian government has had in getting new types of licenses out in the real world, getting UPI out and working. That has been a tremendous positive development, and I mean, every VC I know interested in finance is looking at fintech with new eyes and has fresh hope for the space. So we are watching that very closely. We are also really interested in healthcare. I think the combination of smartphone penetration and open source libraries, thanks to the likes of Google, have given a really new possibilities in the space of healthcare for companies that can use big data for the first time. We're also really interested in what we call the future of work itself. How do we get a whole new class of people who are graduating from high school, going into engineering, to think about how to plan their careers and professional development, given that the tech industry is growing so fast, employing a lot of people, but traditional 4 years of college does not necessarily prepare you for the tech industry's ever-changing needs. So how do we think about employing 30 million people, right? How do we think about as agricultural productivity increases and you have all this migration from rural India to urban India, what are good job categories with professional development opportunity, and how do we create an ecosystem for it? I think that's also a very big business opportunity, so it's a sector that we are really interested in.
Okay, wonderful. So moving on to the execution side of things, Roopa, you support entrepreneurs from very early stage but follow them through to as they're scaling. What are some of the big challenges that you've seen in impact enterprises and their execution, their challenges, and how have investors been able to help, and how should investors think of helping these entrepreneurs?
So I think the first thing to point out is that the ecosystem in India, while it has dramatically improved over the last 5 years, is very different from the Silicon Valley ecosystem, for example, whether it be in terms of the quality of talent, the quantity of talent, funding availability at different stages, and generally the kind of support available to startups. So you have Silicon Valley, which exists because of Stanford, and Stanford, which exists because of Silicon Valley, and you don't quite have that kind of an ecosystem here. Having said that, I think we've observed 2 or 3 key things, challenges as people look to scale. Number one is the fact that at the end of the day, India is still at the lower end of GDP per capita. And what that means is that for entrepreneurs and their enterprises, ticket sizes or ARPUs, average revenues per user, tend to be very low compared to many other markets, tend to be significantly lower than China even, for example. And that has implications for unit economics and scaling up of an enterprise. So that is, I think, challenge number one. Challenge number two is talent. While India does produce great engineers, at the same time, we have a lack of specialist engineering skills. Product management skills are lacking. Sales and marketing is another area where we see gaps. And overall, I think we are also seeing what was talked about earlier, which is entrepreneurs have great ideas, but are often not able to put in place robust systems and processes that can help them ramp up and scale up and continuously take their organizations to the next level. And I think at Omidyar Network, as do all other impact investors actually in India, we provide a great deal of support beyond writing out the check, therefore. So not only do our investors sit on the boards of the companies we invest in and provide strategic inputs, but we also have a human capital team which works with our investees, helping them in recruitment, which is a big challenge in India, attracting and retaining high quality talent, coaching and mentoring the CEO, training teams, helping them in building organization culture, teamwork as the team expands in all of these areas. We also deploy a lever which we call network capital, which is that we connect entrepreneurs amongst our investees to other entrepreneurs that we have invested in, and also other people outside our investee base to help them build networks. So I think, the challenge of scaling is a very real one. And I think it requires investors to play a much larger role and be very deeply involved in walking hand in hand with the investees to ensure their success.
Wonderful, thanks. So Mark, you're seeing execution in a very, very tough field, which is especially agriculture with a lot of distributed holdings. What are some of the challenges you've seen, and how have you been able to help your entrepreneurs?
Well, I would agree with Roopa that one of the biggest challenges is talent. I think, in general, the function of startup success, the main variable, the main driver of success is talent, the ability to get the right people to drive the company forward and reach its goals. And I think in India, it is a very complicated process. One is, despite the kind of startup boom that we're in, young professionals are still very risk averse, right? If someone is is on a good track at a Hindustan Lever or a Goldman or a McKinsey or just a standard CPG, FMCG company or an agri company, dislodging them from that is pretty tough, right? It's in the West, when people join startups, they take pay cuts. Nobody in India has ever taken a pay cut to join a startup ever. It doesn't happen, right? At best, you're going to get them for the same salary, right? So that, it's someone has to come over that hurdle, and that is a very difficult hurdle. That hurdle is further exacerbated if you are outside of one of the main talent hubs. One of the things that we've really struggled with in our first fund, we raised a $40 million fund, we have 12 investments. The investments that are in smaller cities have huge challenges with talent recruitment. It is, very, very hard to get good engineers to move to Rajkot. It is very hard to get good marketing professionals to move to Guwahati. In fact, as we've kind of moved into our second fund, which we're raising now, one of the things we've said is that we will focus on startups that are in the startup talent hubs, because otherwise they are practically stranded from a talent perspective. So that's essentially Bombay and Pune, Bangalore, Chennai, Hyderabad, and Delhi, or the greater national capital region. When you get outside of that, God save you, right? It's, and we're really looking for local talent, right? People that understand how to sell in India, how to manufacture in India, how to grow in India. Lord, God save us from white boys from Stanford. So there are plenty of them. So that's, that I think is one big challenge. I think the other big challenge is with respect to growth capital. And I'm talking about both debt and equity. In general, India has an amazing financial system. It's massive. It is incredibly well regulated. It's also staggeringly conservative at times. I take heart that a lot of those same massive banks are some of our LPs, right? And they're taking that risk through us by investing in Omnivore. But it is very, very difficult for an Indian entrepreneur after they get that first equity check and they need a working capital loan to access that working capital loan. They will have to give personal guarantees. Their flat will have to be mortgaged, right? And there's a limit to that. And you really cannot get debt without that. And then I think, from an equity perspective, it is very, very, very difficult dealing with kind of generalist VCs when they get outside of their comfort zone and start looking at impact spaces, right? I cannot tell you how many conversations that we've had over the years. We have a portfolio company, it's doing $4 million in revenue, it grew 300% the previous year, and the person looks at us and says, they sell to farmers? This is 30 minutes into the meeting, right? And so there is just a lack of education on the part of the venture community in India when we're not talking about social and mobile and food delivery and e-commerce. And so one of the things that we've really done in Omnivore is we've worked very, very hard to build inroads outside of India with family offices in Europe, with foundations in Europe, with impact investors globally to start bringing them into these things, because if we just try to rely upon the generalist venture capital ecosystem, it's not going to work. There is too much education required to kind of get over those hurdles. You bring them a company that has 3 million in sales, they say come back when you have 5 million, you come back at 5 million, they say 10, right? And so we're really trying to find and build a universe, an ecosystem of impact investors globally that are going to start coming into India to help with the scale up.
Wonderful, thanks, Mark. So that gives me a segue, Maya, into a question I've been dying to ask you, which is the ugly E word. bring the reality check back to the room. All the stories are good, but where are the exits? And I think you all have been around long and have had some experience of exits. What should investors be thinking about as far as exits are concerned? What are some creative strategies to generate liquidity?
Yeah, that's a great question. So in India, we've invested probably in about 18 companies to date, and we've exited roughly a third of them, and are in the process of exiting more from our first and second funds. And the way we think about it, to paraphrase my partner Sandeep Farayas, who many on this panel know, he says we're not in the investment business, we're in the exit business.
Right.
And from day one, when you go into a company, there are some cases that we've had where it's been pretty clear where our exit might come from. There are others where it's less clear. But for better or for worse, even in the impact space, when you're managing investment funds and you're a fiduciary for investors who are expecting a financial return, you have to be thinking about exit from day one, from when you do the Series A, how are you constructing the Series B, what are the milestones the company is reaching, who are they attractive to? Are they attractive to a strategic buyer? Will they be attractive to a private equity, upstream financial investor who will buy out your stake? Could they eventually go public? In our portfolio itself, we're extremely lucky. We'd like to say that we're smart. Maybe we're a little bit of both. The first company that we ever invested in and the second company we ever invested in both went public.
Wow.
One went public in 2010. The second went public 2 months ago. And so we've had exits by virtue of going public on the public markets, but negotiating how you get out of those companies as you move into the going public process, or once you're a public company, how you negotiate maybe unloading part of your stake at the IPO. You may be locked in for a year or 3 years after that. You may still own 8% of the company. How do you get out of that a few years in without roiling the markets? There's a lot of very careful strategy and planning around that. So it's not just you go public, you make 7 times your money and you're done. There's actually a lot of hard work that goes around how do you exit your stake in that process. We've also been lucky enough to exit to strategic sales. So they're upstream banks or financial institutions who look at some of our specialty finance companies, whether they're microfinance institutions or slightly different, and say, rather than build my own division that's focused on that market, I'll just buy your company. So we've had that happen. We've also had situations where we've exited and we got $0. That's a lot of fun. And often those exits are as hard in terms of how much time they consume, how much emotional energy you put into taking care of your companies and shepherding them to the right end. I think with impact investors, the hard thing for us with companies that aren't doing well is that they are providing services that in many cases are serving critical needs. So we had a company that failed, and it was probably a 3-year failure. So it wasn't a flame out overnight, but it was a long process. And this was a company that was serving 50,000 people a day in rural villages. How do you let that go? How do you try to find a safe haven for them? Those are very interesting experiences to go through. So we have lots of war stories around exits. Luckily we have lots of successes around exits. We've also exited to private equity funds who have come in and looked at our companies just purely as a good growth opportunity. There's a lot of conversation around, is there mission drift when you get out? How do you think about all of those things? It's very complicated, and it is much harder to exit than it is to make the investment. So it takes a ton of work. And I think that's the bottom line.
Thank you. And so Raymond, you touched upon the reason we're all here, which is the impact. And what's been your experience of the state of impact measurement, some interesting structures you might have seen to keep companies focused on defining their theories of change and measuring them rigorously and making sure that they're not greenwashing themselves and they're actually delivering the promise that we all had when we invested in them?
Yeah, so it's a good segue from exits, because that's what everyone actually talks about, right? They talk about all this money is going into impact investing. Like, where are the returns? Are people exiting? But the funny question to me is that no one actually really talks about the impact. So my question is, where is the impact? If there's been $1 billion going into India alone, right, in social impact investing funds, where's impact? Like, impact investing is put forward as a way that's better than traditional development. It's using markets to drive impact, using markets to, for-profit means to help solve problems that development aid couldn't do before. Sure, I believe that theoretically, but in practice, if all funds are going in looking at where can I make money, can I generate income from this sector, then they completely miss the whole point, I feel. I feel like a lot of people should be doing, and the way we look at it is this sector and is this company able to actually help the people we say we have money to help? And can we actually prove that that can happen? And then can we set them up to actually solve those problems? So there's tons of money going around, tons of small little companies thinking, dabbling, but very few of them actually reach scale. Very few of them actually have generated any real income. And part of the problem, I feel like, is that most of the investors don't really have a preference for that. You meet tons of really great investors on panels and in this conference that are great financial analysts, great deal people, but then you ask them about like the cultural context of where they're investing. You ask them about the actual development issue that they're trying to solve when they're investing. Well, we asked the company to tell us. That's the same problem that development has. Development agencies used to have a problem where they would give money to somebody, and 5 years later, they'd be like, here's a grant again to tell me how well you did to me, how much impact you did. Right. Investors are doing the same thing. Investors are investing in a company, and then they're asking them to self-report how many people you helped and what's your impact. If we're going to raise money and then invest, we should be also held accountable for what impact we're generating, and we should put an emphasis on that too. So just as when I make an investment, I'll make sure that the accountants have the books right on the company, I'll also make sure that there's someone there seeing, in fact, whether or not this company is actually creating an impact. And I don't think until we as investors put the onus on the companies to prove that, and we actually put social impact first in terms of where we put money and whether or not we're going to deploy capital, then no impact's going to really be generated. We're going to be crowding into companies and crowding into sectors like microfinance, and we're going to crowd into areas where there turns out it doesn't really create an impact. Like, all those things are necessary, and I think there's lots of sectors where you can make money that's useful, but don't try to say that we're your social impact investor and then invest in something that isn't a social impact.
Okay, we have about 15 minutes left, and so we'll open it up to audience questions. There are 2 mics that are roving around, and just wait for the mic to come to you. And if there's a specific panelist that you'd like to answer your question, please mention that too. Can we have the mics, please? Why don't you go ahead and we'll just repeat your question.
I wanted to ask the panelists a question. You said there's so much money in impact investing. Money's just flying around. How do you compare that to the numbers we know from U.S. venture capital association? So there's roughly $60 billion in venture capital in the United States, 30-something billion in China, maybe 5 in India. You just said maybe there's $1 billion in impact investing. So is there really that much money flowing around?
Well, in fact, there isn't. I mean, people aren't deploying capital.
Sorry, the question was, is there really that much of money in impact investing in India? Is there really $1 billion, given that the entire VC industry in India is $5 billion? That was the question.
Yes, so if you look at it at a grand scheme, no, it isn't. But if you look at it at a micro scheme, if you give a company $500,000 that's working in rural India, that is a lot of money. And if you think about the amount of money that's sitting in these different funds, there is a lot, but it's actually not going out the door. Because if they're all sitting back waiting for the $2 million deal and not going down to where the deal should be. So yes, there's tons of money in the developed world. Yes, that's very true. In terms of the impact investing going in one country, India, yes, there is a lot if you compare it to Western Africa or South Africa or even in Southeast Asia. So I get your point, yes, that there isn't as much money as Silicon Valley, but it's a pretty broad example. It's like trying to compare investing in New York to Singapore or to Sri Lanka. That's not a fair comparison. The fair comparison is in India as a microcosm of social impact investing. The vast majority of the money is going into India, and it's the most developed market for social impact, and it's been around, and it's the most developed and biggest ecosystem, and yet there still isn't any like measurable, tangible impact yet. So I get concerned when you talk about East Africa following the path of India. If it does that, then we're going to be stuck 10 years talking about East Africa in the same way we're talking about India right
Maya, Mark, Roopa, do you see a lot of money in India? Or outside of microfinance, I think there's not that much, I think the data that seem to indicate, right?
Yeah, I can't cite the data, but I think the interesting trend over the past few years is that there is more capital. I think that the mainstream investors have started to come in and look at the growth prospects of some companies and come down. The level of smart capital going to the right places, I think, to your point a little bit, is an interesting one, because there's a lot of conceptual intuition and assumption around what creates impact. There still isn't a lot of robust data. And I think I agree with the point that you're making, that collecting metrics is one thing, but do we know that those metrics are actually indicators of positive economic and social outcomes for people, and is the money going there? And I don't think that has happened yet, because the level of data is not yet at the point where we can definitively say that's where the money should go. There's a lot of money, for example, that goes into financial literacy training. And if you talk to behavioral psychologists, they'll say that financial literacy training has zero impact on getting people to save. So why is all the money going there? People assume that financial literacy training increases and improves financial behavior. In fact, scientific studies show that it doesn't, and it's other types of interventions that actually may get people to save. And matching the evidence of where impact really is driven with where the money is going isn't happening in a cohesive way, I think, as yet.
But we're all kind of in the development business to some extent, right? And this is a relatively nascent space. Let's be clear, nobody for 6 decades has perfectly figured this out. The US government has set trillions of dollars on fire with nothing to show of it.
Yeah,
so I take some umbrage, right, at the notion that this space, which has been trying to figure it out for 10 years, more or less, hasn't perfected it. I agree that there was a lot of thinking that microfinance was massively impactful, and there are some people that still think it is, and there's some people that think it isn't. But the notion that this has been a total waste, you know, especially as these companies have scaled and gone public, I think is flatly wrong. I think if you want to...
I'm not saying it's a total waste. I'm saying that we're going down the same path as the relevant. And I'm not saying the United States government or
I'm not sure that
others...
that's true, because I don't think the US government took a lot of things public that became self-sustaining without endlessly pumping money into them. Right? And I think if you do want to look at a very clear example of impact, right? And I mean, look, it's my space, so I'm going to plug it, right? We know from development economics that agricultural growth yields the greatest impact on poverty alleviation of anything in the world.
That's
right? And maybe I'm going to figure this out later, but right now, right, with 12 companies that have been operating usually for less than 5 years, we've got 2 million Indian farmers that the Omnivore portfolio is touching. We are trying to measure the impact of that, you know, and as we see it evolve, we see a real tangible impact. But I fully agree, this is an evolutionary process for all of us.
Yeah. No, so don't put me in a position as defending the US government, because that's not what I'm trying to talk. I'm not saying development aid is the way of the future. And I firmly believe, and I'm in the business of, that we should be investing to drive impact. But what I'm concerned is, we are still not being diligent about what does drive impact. 2 million farmers reached, that's phenomenal, but what does that actually mean?
That's fair. I think that's a fair point. I think the practice is improving. One last closing comment, and then we'll go to the next question, please.
On this question on where is the money going, there is no doubt about the fact that the initial years saw a ton of money going into microfinance, but happily, I think from what we see on the ground, is that situation is rapidly changing. We don't have a single microfinance company in our portfolio, and we have done 60 investments so far. And so where are the opportunities? We are seeing opportunities in fintech and bringing in massive numbers of people into the fold of formal financial services. We are seeing opportunities in edtech, in health, jobs, access to transportation, so a whole range of what we refer to as utilitarian products and services, which provide access to people who are underserved to basic goods and services, which they otherwise might not have had access to. And I think directionally, we can see clear trends of the money shifting there.
Okay, great.
Just one
That
last
gentleman.
quick
Yeah,
comment
sure.
on this. So we, in answering this question of, on the spectrum of rigorous impact measurement versus kind of first principles thinking, our fund is also a very firm believer in first principles thinking. And since we don't have entrepreneurs represented here, I want to give an example of what happens in the impact ecosystem when investors who want to do rigorous impact analysis don't have their own model figured out, right? So we have a company that is on its way to becoming the largest chain of rural preschools in India. Almost no one is doing that. They're practically the only company setting up preschools in very, very remote rural India where the state of education is extremely poor, right? And they haven't had a lot of resources. They haven't done like rigorous control tests to prove what the impact of their education is. The fact is that their students don't have any other alternatives. So for me, the impact is approaching infinity. But when they go to the traditional impact investing ecosystem, what they hear is stuff like this. They hear folks who say, oh yeah, well, we're not really looking at preschools this year. We want to focus on like schools. They hear people saying, and this is traditional impact investors who have rigorous models of what they are measuring for their own team. We hear people saying, well, you haven't done rigorous control tests yet. You haven't published papers on your impact. And my question to them is, if you step back and do some first principles thinking here, this is a country of 1.3 billion people, 70% of the population is rural. This is the only startup in your pipeline trying to educate their children. And you're saying you don't have enough evidence of your impact model. And I don't understand that. I think there needs to be a balance between
I think we can continue that
rigorous
discussion.
measurement
I think that
and first
gentleman's been
principles.
waiting.
I want to ask a question about impact measurement, but I'm happy that you go.
Yeah. So this is a great point. If we have children and you put them into a school, do you want to make sure that that school is actually providing your child with the type of environment that's suitable and nurturing?
Let me add to
Let me
Raymond's point,
finish.
especially with a family which has a 2,000 rupee income, and if you're going to charge them 300 rupees in fees, don't you want to make sure the children are learning something?
Exactly. So if I had a child and I put them in a school and you do it in the United States, there's tests, there's evaluators that tell you these schools are good, these schools are bad. Just because it's in India, just because there's not anything there, doesn't mean just because you're doing it that it actually is helping them. If we're going to put them up and say this is the group that should be scaling up through the whole country, be at least sure that that's actually working. If not, why is that group as opposed to government doing it? So the reason why some impact investors are like, maybe we're not going to invest in that group is because of, I don't know if that actually works or not. And if it was my child going to that school, I'd want to know if it worked first. So before you push forward a group, you should actually know that. So I hear your point about too much rigor, but if you put yourself in, the reason why impact's important isn't because of a metric, isn't because of reporting, it's because it's actually human, it's a person. And you're selling something, you're making money off of something, so if you're going to do that, be sure that it's actually helping that person. Be sure it's not just pushing them along and they're getting the results that they would otherwise.
You don't think that the parents who are choosing every month and every year and are happy and have high customer satisfaction is not a metric?
You're showing exactly what investors do wrong, which is you're missing the cultural understanding of it. Parents actually are really bad. Parents are actually really bad at actually.
I do understand the cultural context.
But parents are really bad at choosing education.
Parents are very bad.
That's why they have independent evaluators do it. If there isn't an independent evaluator there, then you bring in your own bias to choosing that school because you're like, I grew up in a school like this, so therefore I think my kids should be that way. But actually, that's not actually how it works. So that's why you need someone outside of the person that's vested to tell you that it's going to work, tell you that it actually works or not. And then compare it to 4 other schools that are doing something completely different. And then maybe one of those 4 schools.
She's got you there.
Okay, so I think let's go to the question.
I don't think
Do you have any other questions that
about
you'd like
the
to
same
ask?
problem anymore.
Okay, let's
next
agree to
question.
park this for now. I think we've got another 5 minutes to wrap up. So.
Yeah, so I have mixed feelings about the fact that the panel is split on impact measurement. I want to go back to you, the gentleman from Omnivore and Raymond as well. You mentioned about the lack of technology and expertise back in India, especially in the non-mainstream cities. And then you spoke about how you would want to emphasize on impact measurement for your investees or the enterprises on the ground.
Yeah.
How are they supposed to do this, and what kind of technology do you think they can leverage to do that? Is that a possible mainstream market there? for people to be able to do that in the first place?
I don't think there's a lack of technology expertise in India at all. What I said is that, for example, it tends to get clustered, right, in certain areas. So if you want really, really good mechanical engineers, right, you're pretty much talking about Pune and Chennai, right? If you want really, really good chemical engineers, it's Bombay, right? If you want amazing IT, right, it tends to be highly concentrated, right, in Bangalore and Chennai and Hyderabad. It's a little more disparate. What I was saying is when we've done some of our investments that are further afield, right, you know, in Rajkot, you can get a good shop foreman, right, who can work in fabrication. It is much harder to get, right, a product designer, especially someone who is well-educated, postgraduate, right, and has good work ethics, right, in you know, at a Mahindra or a John Deere or something like that, to move to Rajkot and work for a startup company, right? It's not a lack of it's not about the country in aggregate having a lack of technological expertise. Quite the opposite. India has a surplus of technological expertise. It's about the spatial location and the spread of that expertise.
Lack of mobility in some sense. The lack of mobility in some sense in that pool.
And honestly, the thing that we've discovered over the years, and it's probably a positive thing, is one of the reasons why talent is concentrating isn't just about the talent, it's about their wives or husbands or partners.
Schools.
People are unwilling, as you have a rise of dual income families, right, people are concerned about the career of their partner. And so once upon a time, so 30 or 40 years ago, right, if you worked for an ITC or a Godrej and you were told, okay, you have to move to Surat, right, or you have to move to Jalandhar, you packed up the week later and you went. Now that you have more dual income families, it's much, much harder to get talent to move to places where the partner isn't going to be able to find a comparable job. And so that's something that we've just seen again and again and again.
Okay, I think we've almost run out of time, so quick round of closing comments.
There is one more question if I can ask.
Unfortunately, we don't have time.
Okay.
Just, quick closing remarks. So we'll start with Raymond and then we'll come back to Sandhya. Any two thoughts that you'd like to leave the audience with about investing in India?
Yeah,
I
I hope everyone doesn't take my comments as if I don't believe in this space. I definitely do. I just think that we need to be more vigilant and honest about the debate and push ourselves and push our entrepreneurs to go into spaces and demonstrate whether or not we're making impact. I want this sector to work, but I feel like if we aren't honest and we aren't vigilant about what we're investing in is creating impact, then it's not going to work.
Okay, Roopa?
I think what is very important for investors as they think of investing in India and as they look at entrepreneurs is to consider whether the entrepreneur is offering an underlying affordable product or service using frugal innovation, because that is the only way to really tap into the mass market, particularly the $2 to $8 segment that I talked about earlier, and to achieve impact at scale. And the second point that I will make is that it is, again, a learning for us is that you need patient capital. Scaling is going to take longer than you expected. Exits, as Maya so eloquently explained, are incredibly complex and problematic in India. And so I think investors should be prepared for the long haul when they invest in India.
Wonderful. Mark, 30 seconds.
I think India is very uniquely positioned to become really the largest example of impact at scale and impact exits of any market in the world. I think at the same time, what worries me is I see traditional impact investors, right, especially here at SOCAP, that are, again and again and again, I just do Sub-Saharan Africa, I just do Sub-Saharan Africa, and that's great, right? That needs to happen, that attention needs to be there. I think we need to kind of refocus eyes on India to an extent. There's this notion that's kind of spread through the development community that India is a middle-income country, right? And it's because if you stay at the Taj in Bangalore, right, you might think that, right? But the reality is, for half of the country, right, it is absolutely not. It has worse food security and malnutrition than sub-Saharan Africa. And so I think we need to do a greater job educating impact investors of the challenges that we still have, and yet that this is a market that is capable of long-term sustainability. We have real capital markets. You can take a company public in India, which is not true in most of sub-Saharan Africa the same way, right? You can actually scale from a talent from a talent and manufacturing perspective, which is much harder in a place like Kenya or Nigeria. And so I think there needs to be more investor education that creates a refocusing as we push forward.
Okay, Maya?
For us, and I think within the impact space, India is one of the great sort of cauldrons of experimentation and success, partly because of the density of the population, partly because I would say of the overwhelming talent, that you can find. It's not ubiquitous, but there are some amazing entrepreneurs when compared to entrepreneurial spirits that we find in other parts of the world. It's very hard to compare to India. But I think, the note of caution that we're talking about is important because there's a lot of trendiness to impact investing, and the important thing is to remain authentic about a bottoms-up view as to what people really need. To the points made earlier, the rural market is not well served. There's a lot of need. There's a lot of clustering in certain cities, in certain parts, and the hard work is out in the field. We can't ignore that. There's clustering around some sexy and hot sectors, which floods capital into certain areas. We can't just do that. We need to look more ubiquitously. And I think that even though we think the infrastructure is very developed, there still is a lot of work to be done on ecosystem in India, whether it's alliances between different companies that are working in the same sector, interactions with regulators, and having enlightened regulation of certain spaces. This is a lot of the work that Omidyar Network does to build the infrastructure around India. Even though there are great successes, there's a tremendous amount of work that still needs to be done, and it's important to be recklessly cautious.
Okay. Great, thank you. And we started with you, Sandhya. We'll wrap up.
Yeah, I think, when I think about why people often misunderstand or trip up around the Indian VC ecosystem, I think about the William Gibson quote, which is, the future's already here, it's just unevenly distributed. And India's a perfect example of that. You have people who still don't have electricity, and at the same time, you have someone in Bangalore who's just like building the exact business model that someone in Silicon Valley is working on. You have all of that happening at the same time. And it's not even just rural versus urban. Within urban India, you have, everything from, complete and dire poverty to extreme riches within single city ecosystems. So they're extremely diverse when it comes to economic issues, and none of the frameworks that have generally applied in other countries can simply be translated to the Indian ecosystem. You have to do bottoms-up thinking, both on impact, on business model, on how we'll get talent, all of that. You have to be very, very innovative.
Okay, wonderful.
And I think that applies equally to investors and entrepreneurs.
Thank you. And so we gave you your morning dose of fireworks. Thank you very much for joining us. Thank you to our panel.
And can we give a hand to Guns, our moderator here? He did a terrific job.
Thanks a lot.